Well, here at Question Time, we continue to get lots of great questions from you. And Steve Brennan, what's the question for Joe today?
Yes, the question from one of our followers is it conceivable that housing prices might drop, maybe due to more supply, if rates are lowered, even if they don't go all the way back to 2%? And I'll throw in a writer on that. Rather than seeing housing being disinflationary, does it seem housing costs are likely to contribute to inflation over the long term, Joe?
Okay, well, that's a whole bunch of stuff. Well, first of all, I have actually put forth that idea before in my weekly commentaries that it is possible that if rates come down, you could see an increase in supply, which would affect prices. But it's hard to judge in advance because we don't know. There's two things involved here, the supply and demand. So the thought is, hey, interest rates come back down, and a lot of the people that have been sitting in a house, they got a 3% mortgage, they don't want to move. Okay, they don't want to move because you got to go and get a 7% mortgage now. So they're doing their best to stay in this house at 3%. But if you bring rates down and you bring down the rate, say to 5% or 4.5% or something like that, then maybe these people would move. And I think that's probably true. And I do want to, we initially started these things where I didn't know what the question was going to be, but I do read the comments, so I knew what the question was going to be. So let's look at a couple of things here. This is existing home sales. Let's go with this one first. Existing home sales running about a 4 million rate, which is way below the average since 2000. Average since 2000 is about 5 million. So obviously people are not selling their houses. This is existing homes. This is existing single family home months of supply. And it's at about 3.5 months right now. So that's at the current sales pace. The current sales pace is 4 million. And so at 4 million, you got about 3.5 months worth of supply. So what do you got? 13, 14 million houses on the market, right? And a country of however, what are we, 330 million now, something like that? Not very many houses. So that's the problem that we're trying to solve here, or trying to think we need to solve. The idea is that if rates come down, more houses will come in, more inventory, and prices will come down. What I would say is that, first of all, inventory is so low, you got to get up to like 5.5 months. We're at 3.5 now before you even get back to normal. So I wouldn't expect that just you would get some immediate price drop. That's not going to happen. I do think the market would normalize, and you would probably see price increases fall back to the rate of inflation, whatever that happens to be. Now, by the way, this is called the lock-in effect, and I'm gonna veer off course here. I know Steve asked another question, but I'm gonna veer off course a little bit here. And I don't remember which country it is, but it's one of the Nordic countries. They have a very, very interesting system that avoids this problem. Here's what they do: when you take out a mortgage, there is a publicly traded version of that mortgage that you can go out and buy. So if you have a 3% mortgage and rates go up, you can then go buy your mortgage at a discount. And when you go back to pay it off, if you sell your house to buy another one, now you make that profit. So say you've got a $300,000 mortgage at 3% and rates go to 7%. Now that $300,000 mortgage only has a value of, say, and I'm making up numbers here, say it's $250,000. So now you only got a $250,000 mortgage. You can buy that thing back at $250,000 and go to the bank and say, I'm paying off my mortgage. And now you've got this thing that allows you to capture that difference between where rates are now and where they were when you took the loan out. So that's a way to end this lock-in effect. And we could do that here in the United States. It would be very easy to do. The reason we don't do it, banks don't really like it. Banks don't like it at all. Now, it's funny because, in a way, you think about the banking problems that emerged last year. They emerged because a lot of the things that they had on their balance sheet went down in value because interest rates went up. This will be a way to, again, alleviate that problem. So it alleviates the pressure on the banks, it alleviates the pressure on the real estate market, and allows that lock-in effect to not happen. So that's kind of interesting. Now, long term, I got to tell you, I'm a little confused about long term, and I'm not afraid to say that. I've always said this: I can't predict the future. I don't know. But there's some other things involved here too that are interesting. Everybody keeps saying we have a shortage of housing. And I suppose we must because prices have gone up and so forth. But maybe what we have is a shortage of housing in certain places. Maybe there's a shortage of housing in the South and not in the North. Maybe the problem is location rather than actual volume. I do think that if we continue to see that migration from north to south, which we've seen, then you could end up with, again, a shortage, and house prices in the south could be, still steamy. On the other hand, if global warming actually continues to happen, or global climate change, whatever you want to call it. Listen, I live in the south, guys. It's getting hotter. If you've been to Arizona, it was 115 degrees yesterday, I do believe. That's not new. I mean, obviously, Arizona's been hot for a long time. I do think there is climate change happening, though. It's very interesting. In fact, it's happening so much in my area that we actually changed our growing zone. The USDA changed it from 8A to 8B because our winter temperatures are about 5 to 10 degrees higher. The lows are 5 to 10 degrees higher than they used to be. So the question then is, are you going to see housing be a part of the inflation problem going forward? Well, I don't know. I think it might be, because I think we do have to build houses where people want them. And I think that's part of the problem, is that we've got housing in places where they don't want it. And people, I'm sure, I could be wrong, but I bet you there's plenty of inventory in Chicago. But I could be wrong about that, but I don't know for sure. So I honestly, Steve, I don't have an answer for that question just yet. I think inflation is about the currency. And the currency is about, in our case, the dollar. If the dollar goes down, you're going to have sustained inflation. And really a falling dollar and a rising interest rate environment, which is where I think we're headed, that's an inflationary environment. That's exactly what that is. Rising rates would be rising nominal rates, would be rising nominal growth. And a falling dollar would indicate that real growth is not that good. That's the inflationary environment that we're worried that we're headed to. And so that's what I would be concerned about. I don't want to put it on one thing and say it's going to be housing. I think it's about the currency. And that's what we want to focus on, because that's the thing that affects our portfolios.
Keep your questions coming and put them in the comment section down below.